Empires are often remembered for their armies, their monuments, and their conquests. We picture marching legions, towering walls, and banners carried across distant lands. Yet behind every army that crossed a frontier stood something far less dramatic, but infinitely more decisive: a financial system capable of sustaining it. Long before the rise of modern central banks or the dominance of the pound sterling, early banking quietly determined which ancient civilizations would flourish and which would fade into obscurity. To understand how early banking changed the fate of ancient empires, we must first abandon the idea that money is a modern invention. As early as Mesopotamia, temple complexes acted as financial institutions. They stored grain, recorded deposits, extended credit, and charged interest. These were not primitive experiments. They were structured systems of trust. Clay tablets served as contracts. Debts were calculated with precision. Wealth was measured not only in silver, but in confidence. This was the birth of organized financial power. In the ancient world, surplus production created opportunity. But surplus alone was not enough. It had to be managed, stored, and redistributed. Early banking institutions emerged to solve this problem. They transformed static wealth into circulating capital. Farmers could borrow against future harvests. Merchants could finance distant trade. Rulers could advance funds for military campaigns before taxes were collected. In other words, banking allowed empires to move faster than their resources would normally permit. As Greek city-states expanded trade networks across the Mediterranean, private banking houses refined these practices. Deposits, money changing, and maritime loans became central to commerce. Risk was priced. Credit flowed between ports. Financial intermediation began to underpin political influence. The ability to finance fleets meant the ability to command trade routes. Rome would inherit and dramatically scale these mechanisms. Its expansion was not simply a story of disciplined legions. It was also a story of taxation systems, treasury management, and creditor networks that stretched across continents. The Roman state understood something fundamental. Conquest required liquidity. Soldiers needed paying. Roads required maintenance. Provincial governors demanded funding. Financial administration became inseparable from imperial governance. Yet embedded within this innovation was vulnerability. Early banking tied the stability of the state to confidence in its currency and its debt obligations. When trust held firm, expansion accelerated. When trust faltered, strain emerged. This delicate balance between credit and credibility would prove decisive. The ancient world reveals a pattern that would echo centuries later in the British Empire economy. Long before London became the center of global finance, the principle was already clear. Power flows through financial systems. Control of money is control of momentum. The strength of an empire depends not only on what it conquers, but on how it funds its ambitions. The story of early banking is therefore not a marginal footnote in economic history. It is a central force in the rise and fall of civilizations. Empires that mastered credit could project influence far beyond their borders. Those that mismanaged debt or undermined their currency faced contraction, instability, and eventual decline. When we examine ancient empires through the lens of finance rather than warfare, a different narrative emerges. Behind every territorial gain stood a ledger. Behind every campaign stood a creditor. And behind every moment of expansion stood a financial system balancing opportunity against risk. The question is not whether early banking mattered. 'Tis how profoundly it shaped the destiny of empires and why its lessons continue to resonate in the new study of money and power today. Imagine a world without money, where every transaction is a direct trade of goods. A farmer swaps a sack of wheat for a potter's clay jar. This is where our story begins, long before the sleek glass towers of modern finance, in the fertile crescent of ancient Mesopotamia. This is the story of how banking was born. Our journey starts over 5,000 years ago. As hunter-gatherer bands settled down to farm, something remarkable happened. They produced surpluses more grain than they could eat, more wool than they could wear. This surplus became the first form of wealth. But how do you store it? How do you trade it effectively? Storing grain is one thing, but carrying it around to trade is another. And what if the person you want to trade with doesn't need your grain? This is the problem of the double coincidence of wants, and it was a major hurdle for early economies. The solution came from an unexpected place: the temples. In cities like Uruk and Babylon, massive temples, or ziggurats, dominated the skyline. These weren't just places of worship. They were the economic hearts of the city. People trusted the priests, and they believed their gods would protect whatever was stored in their holy houses. So farmers began depositing their surplus grain and livestock in the temple storehouses for safekeeping. The priests, in turn, were meticulous record keepers. They didn't have paper or computers, of course. They had clay and a stylus. When a farmer brought in a bushel of barley, a priest would press a record of the deposit onto a wet clay tablet. This tablet was more than just a receipt. It was a promise. It was proof of wealth held in trust. This, right here, is the birth of credit. The farmer didn't have to carry his grain everywhere. He could simply use the clay tablet, his credit note, to trade. He could pay a craftsman with a portion of his stored grain, and the transaction would be recorded by the temple scribes. The grain itself never had to move. These temples became the world's first banks, dealing in the most valuable commodity of the time: agricultural goods. As societies grew more complex, so did their financial needs. Let's fast forward a bit and sail across the Mediterranean to ancient Greece. Around the 6th century BC, the Greeks were master traders and seafarers. Their city-states, like Athens and Corinth, buzzed with commerce. The marketplace, the agora, was a chaotic symphony of different languages, goods, and, crucially, different coins. Each city-state minted its own currency, each with a different weight and purity of silver or gold. Imagine the headache. How do you know if a coin from Sparta is worth the same as a coin from Athens? Enter the trapezitai, or the first private bankers. The name literally means table man because they sat at tables in the agora, ready to do business. Their first job was simple but essential: money changing. They would weigh and test coins for purity, charging a small fee or a geo to exchange them for local currency. But they quickly evolved. A merchant with a pile of cash would unwant to carry it around or leave it unsecured in his home. So, he would deposit it with a trusted trapezites. Like the Mesopotamian priests, these Greek bankers accepted deposits. But they took it a step further. They realized that not all depositors would ask for their money back at the same time. So, they could lend out a portion of these deposits to other merchants who needed capital, charging interest for the loan. This is the foundation of fractional reserve banking, a concept still central to our financial system today. They even pioneered complex financial instruments. A shipowner planning a long voyage to Egypt needed money for a crew, cargo, and supplies. It was a risky venture. The ship could sink in a storm or be captured by pirates. The trapezites would offer a maritime loan. The interest rate was high, often 20 or 30%, to reflect the risk. But here's the clever part. If the ship and its cargo were lost at sea, the loan was forgiven. It was part loan, part insurance policy. The entire agreement would be written up, signed, and witnessed, creating a legally binding contract. From simple money changers, the trapezitai had become sophisticated financiers, fueling the engine of ancient Greek trade. Now, let us journey west to the heart of the most powerful empire the ancient world had ever seen: Rome. If Greece laid the foundations, Rome built the financial skyscraper. The Roman Forum wasn't just a political center. It was Wall Street, the City of London, and a central bank all rolled into one. The sheer scale of the Roman economy was unprecedented. An empire stretching from Britain to Syria required a financial system to match. Here, the bankers were known as argentari. Like their Greek counterparts, they took deposits, made loans, and changed money. But they operated on a much grander scale. They used ledger books to keep track of debits and credits, allowing customers to write the equivalent of a check, a prescriptio, to pay a third party. A Roman senator could pay his builder without ever touching a coin, simply by instructing his argentarius to transfer funds from his account to the builder's. It was a sophisticated system of cashless transfers. But the real financial titans of Rome were the publicani. These were private corporations, syndicates of wealthy investors who bid on massive government contracts. Their most significant business: tax farming. The Roman state didn't have a giant bureaucracy to collect taxes across its vast provinces. Instead, they outsourced the job. The publicani would pay the state a lump sum for the right to collect taxes in a province like Asia or Gaul. Then, their agents would go out and collect the taxes from the populace. Whatever they collected above the amount they had paid, the state was their profit. As you can imagine, this system was incredibly lucrative for the publicani and often brutally exploitative for the provincials. It was a system that financed Roman wars and infrastructure, but it also demonstrated the immense power of organized capital to shape politics and society. So, what happened? If these ancient systems were so advanced, why did they collapse? Well, for Rome, the answer is complex. Centuries of political instability, constant warfare, and runaway inflation took their toll. Emperors would debase the currency to pay their armies, mixing precious silver with cheaper metals. A coin that was once nearly pure silver might, a century later, be mostly bronze with a thin silver wash. People lost faith in the money. Trust, the bedrock of any financial system, eroded. As the Roman Empire crumbled, its sophisticated financial network fell apart with it. For the next 1,000 years, during the early Middle Ages, finance in Europe became far more localized and primitive. Long-distance trade dried up, and the complex credit instruments of the Roman world were largely forgotten. But the principles, the core ideas born in Mesopotamian temples and Athenian markets, didn't disappear forever. The idea of money as a trusted medium of exchange, the concept of credit, and the role of institutions in safeguarding wealth, these ideas were too powerful to die. They were rediscovered and refined by merchants in Renaissance Italy, perfected by goldsmiths in London who issued the first banknotes, and eventually institutionalized in the great central banks of the modern era. The British pound sterling, which dominated global finance for centuries, and the US dollar today are the direct descendants of those Mesopotamian grain receipts and Roman ledger entries. When you use your credit card, transfer money with an app, or take out a loan for a house, you are participating in a system whose DNA was written thousands of years ago. It's a story of innovation, trust, and the unending human drive to create value and connect with one another across time and space. The language and technology have changed, but the fundamental promise that a record of value can be as good as the value itself remains the same. It's a legacy etched in clay, carved in marble, and now coated in silicon, shaping our world in ways we rarely stop to consider. Thanks for watching. If you found this journey through financial history interesting, don't forget to like this video. Subscribe to the channel and hit that notification bell so you don't miss our next exploration into the past. See you next time. Financial systems grant empires speed, reach, and resilience, but they also expose fragility. The same mechanisms that fuel expansion can, under strain, accelerate decline. Nowhere is this more evident than in the later centuries of the Roman Empire, where fiscal pressures began to outpace financial discipline, and the consequences reshaped the Mediterranean world. Rome's earlier success had been built upon a powerful cycle. Conquest generated spoils. Spoils funded administration and military expansion. Expansion secured further revenue. Yet this model depended on momentum. As territorial growth slowed in the 2nd and 3rd centuries, the inflow of new wealth diminished while expenditure remained constant, and in many cases increased. The empire's borders stretched from Britain to the Near East. Maintaining legions along these vast frontiers required continuous funding. Without fresh conquests to subsidize costs, Rome leaned more heavily on taxation and borrowing. Provincial tax burdens rose. Wealth concentrated among elites who could navigate the system, while small landholders faced mounting pressure. Economic imbalance deepened. The financial architecture that once supported expansion began to strain under its own weight. The most revealing signal of this stress was currency debasement. Emperors gradually reduced the silver content of the denarius, effectively increasing the money supply without increasing underlying value. At first, the adjustment was subtle. Over time, it became pronounced. Coins that once contained substantial silver were reduced to thinly coated tokens. Markets responded accordingly. Prices rose, confidence wavered. Inflation is not merely a matter of higher costs. It is a signal of eroded trust. When citizens lose faith in the stability of currency, economic activity distorts. Hoarding replaces investment. Barter reemerges. Long-distance trade contracts. The empire's integrated economy began to fragment. Financial instability translated into political instability. Military loyalty, once secured through reliable payment, became uncertain. If wages were delivered in increasingly debased coin, morale suffered. In some cases, emperors were elevated or removed by legions dissatisfied with compensation. The financial system's weakness seeped directly into the machinery of governance. Simultaneously, administrative complexity grew. Efforts to impose price controls and tax reforms reflected attempts to regain control over a destabilizing economy. Yet these measures often compounded the problem. Price edicts, such as those under Emperor Diocletian, sought to contain inflation by decree rather than by restoring currency integrity. Enforcement proved inconsistent. Black markets flourished. The Roman experience illustrates a broader pattern in empire finance. Debt cycles can mask structural decline until confidence collapses. As long as credit flows and currency retains credibility, expansion can continue. Once that credibility fractures, contraction accelerates. The turning point is rarely dramatic at first. It emerges through gradual erosion. Centuries later, Britain would confront similar pressures within its own imperial framework. The British Empire economy, sustained through sophisticated debt markets and the global reach of the pound sterling, depended upon confidence as much as territory. The lesson from Rome was clear. Even if not always fully heeded, monetary stability is strategic stability. Financial overextension does not immediately destroy an empire. Rather, it constrains flexibility. Resources once available for innovation and defense become absorbed by servicing obligations. Political choices narrow. External shocks, invasions, trade disruptions, internal unrest become harder to absorb. By the time Rome faced intensified external pressures in the West, its fiscal foundation had already weakened. The erosion of monetary credibility had reduced economic dynamism. Tax resistance increased. Administrative cohesion faltered. The fall of the Western Roman Empire in the 5th century was not solely the result of military defeat. It was the culmination of long-term financial strain. Thus, the turning point in ancient imperial history was not a single battle or decree. It was the moment when financial expediency replaced monetary integrity. When short-term solutions undermined long-term trust, the fate of the empire was quietly sealed.
History rarely repeats itself in precise detail, yet it echoes with remarkable consistency. The financial story of ancient empires reveals a structural rhythm: expansion financed by credit, consolidation sustained by confidence, and decline accelerated by monetary strain. This pattern did not end with Rome. It evolved, matured, and reappeared in different forms across centuries, including within UK finance history and the British Empire economy. The fundamental lesson is not that debt is inherently destructive. On the contrary, credit has always been a catalyst of growth. Early banking allowed merchants to trade beyond immediate means, rulers to act before revenues were collected, and societies the coordinate resources at scale. Without such mechanisms, neither Rome nor later Britain could have extended influence across continents. The problem arises not from borrowing itself, but from the erosion of credibility that sustains it. Empires depend upon trust in currency, in institutions, and in the state's capacity to honor its obligations. In ancient Rome, debasement signaled desperation. Confidence waned because monetary policy prioritized immediate relief over long-term stability. The resulting inflation was not merely economic, it was psychological. When belief in the system weakens, power fragments. Britain, centuries later, would demonstrate a more sophisticated mastery of this principle. Rather than relying solely on territorial plunder, the British Empire constructed an architecture of global finance. The pound sterling became a trusted medium of exchange far beyond British shores. London evolved into a center of banking power. Sovereign debt markets financed wars, infrastructure, and trade networks without immediate recourse to currency debasement. Credibility became Britain's most valuable asset. Yet, even this system was not immune to the broader debt cycle. The immense financial burdens of global conflict in the 20th century place unprecedented strain on sterling. The gradual shift of reserve currency status to the United States signaled a transition in global financial leadership. Empire decline was not instantaneous, nor was it solely military. It reflected the rebalancing of monetary power on a global scale. The larger pattern, stretching from ancient temples to modern central banks, reveals a profound truth. Money and power are inseparable. Control over financial systems amplifies political authority. But that authority rests on a fragile foundation, collective belief. When policy undermines that belief, decline can accelerate with surprising speed. The study of early banking therefore offers more than historical curiosity. It provides a lens through which to interpret the dynamics of contemporary economies. Debt cycles continue to shape nations, currency stability remains a cornerstone of influence. Central banks now operate with far greater complexity than their ancient predecessors, yet they confront familiar dilemmas: how to balance growth with discipline, liquidity with credibility. For intellectually curious observers of Britain's economic past, the continuity is striking. From Roman denarii to sterling bonds, from temple ledgers to global clearing houses, the underlying mechanism persists. Expansion is enabled by financial innovation, sustainability depends upon restraint. Decline follows when expediency overwhelms integrity. The fate of ancient empires reminds us that visible power, armies, monuments, ceremonies, is often the surface expression of deeper financial currents. Beneath every period of dominance lies a monetary framework that must command confidence. When that framework falters, even the strongest empire can weaken from within. In the end, the decisive battlefield of history is not always geographic. It is often financial. The ledger, not the sword, determines endurance. And the lesson that echoes across millennia is clear. Those who control money shape destiny, but only so long as trust remains intact.